Thank you so much. Well, good to have all of you here. And thank you very much for hosting us to the organizers. I guess maybe just a round of intros from ourselves first, and then we can kick off with the presentation, which we'll try to keep very short, as we try to do with all our materials. So I'm Fahim. I've been at RetailBook for about 6 months. Prior to that, spent 5 years at Primary Bid. For the basically 6 years trying to make sure that me, ourselves, you, everyone, all retail investors are able to participate in primary market transactions here in the UK. What that means, we'll go through that in that presentation. Nick?
Yep. Hi, everyone. I'm Nick Dilworth, MD of Legal Risk and Compliance at RetailBook. After hearing kind of Lord Lee talk about the overburdensome compliance, it's quite a slightly intimidating place to be. But I'd say in terms of my role, it's really about kind of facilitating and making sure we find the solution around the navigating that difficult regulatory landscape. But I've been in capital markets now for 20 plus years, started my career off at Barclays, and I've worked at Dilworth, London Stock Exchange, Winterflood Securities, and now at RetailBook.
Thanks, Nick. I'm Tushar. I'm VP of Distribution at RetailBook, similar to Fahim, ex-Primary Bid, and now at RetailBook. And my role mainly consists of connecting and working with our distribution partners, ranging from the largest investment platforms all the way down to your traditional stockbrokers, and working with them to really distribute all the transactions that RetailBook facilitates to their underlying individual investor subset.
Perfect. Thank you. First slide is basically just to give you an idea what we do. We are basically, let's put it this way, the plumber that makes retail, connecting retail to the issuers. So when a company like, well, I'm going to use a very bad example, Royal Mail, looks to access public markets, which they did so about 12 years ago, they did a very public IPO. It was a sell done by the government. So Royal Mail would actually go to somebody like us when they look to appoint or distribute those shares to retail. What that means is an issuer like Royal Mail will appoint us, and then we will go and talk to all your brokers like Hargreaves, AJ Bell, Interactive, and so on, the whole list. Tush manages a list of 50 plus, and we will facilitate those transactions so all of our cells are actually able to participate in those transactions. What we have done over the last 6 years or so is essentially institutionalize that process. In the past, if you think about Royal Mail, Saga, Merlin, some of the bigger IPOs that happened 10 years ago, retail was given access very sporadically, maybe 1 or 2 deals a year. The difference now is if a company is raising capital, whether through an IPO or any subsequent follow-on capital raises, retail is now almost always included. Why? Thanks to our plumbing. What we have done is we have made it very easy for issuers like Royal Mail and others to get retail investors like you and me participating in this transaction in a very seamless and quick way. That is the whole reason we exist, and we've been able to facilitate that. What that means is, I think over the last 6 years, what we've been able to do is we've worked on more than 400 equity transactions listed on the stock market here in the UK and raised nearly 2 billion of funds that went into those companies from individual retail investors like ourselves here in this room. That has not been at that kind of scale ever in the history of our capital markets. So I think that's why all the regulatory changes that you've been hearing about, I think over the last, few years, I think is very important for us. And that's what Nick's going to talk about as well as we go into some of the presentations. This is just us, just to give you an idea who we are. I think as you heard, all of us, we have a whole colorful history, but the point is we have more than 200 years of experience between us working in capital markets, not only on the distribution side. So we have partnerships or basically experience dealing with brokers, dealing with issuers, the whole legal and compliance, the entire span. Like if you think about the 3 of us here, I'm the one who actually goes and talks to Royal Mail and try to win the deal. Nick over here makes sure that I'm doing it in a very proper way, legal compliant. Tush is going to be facilitating that deal into your hands through your brokers. So that's how we operate. And Nick is basically, of course, going to make sure that Tush is doing everything that is appropriate and proper when they're talking to your brokers and downstream as well. So any communication on a given transaction that you would be receiving from your stockbrokers, as long as they're mandated with us, we will have reviewed those communications and approved those and will be under Nick's purview to some extent. So therefore, we're making sure the entire journey that we bring the retail investor along has an oversight from us and benefits from our experience, so that so when you actually see the opportunities, actually it has been vetted not only by the banks, but also somebody with a very strong retail lens. I guess as a Q&A point, I guess first the questions is like, we've talked about, you might have seen Simon's French presentation earlier about, the different asset classes. I guess this is a question just to test the room. Like, these are the kind of asset classes that we look at: equities, funds, and bonds. I'm assuming people in this room has some familiarity with those products, are already invested in those products. If not, maybe shout, then we can try to tone down the presentation accordingly as we go along. To give you a size of the opportunity, I talked about IPOs and follow-ons. IPOs on an average year makes up about £8 million of issuance. And if you look at follow-ons, they make up 11 billion on a yearly basis here in the UK. So that's about nearly 20 billion a year, just on equities alone in terms of primary market issuance. And we have been able to generate 2 billion over a period of 6 years. What that tells you is there's a huge upside curve just for IPOs and follow-ons. Because if you think about like the yearly volumes versus our six-year aggregated volumes, you're only touching the surface of it. And then as the whole regulatory landscape changes, as we look at other asset classes like private assets, bonds, UK Treasury bills, UK gilts, all of those are asset classes which are not very easy for retail to access. So that is where we're also facilitating a lot of these conversations. For the last 12 months, for the first time ever, we're enabling UK retail investors to purchase UK government treasury bills. That is quite a statement, because if you think about it, it's the UK government who's the seller here, and they have not been necessarily systematically selling it to the UK public. You could not buy it through your Hargreaves ISA or SIP account until 12 months ago. We made that happen today. So when you're able to buy these government treasuries to a lot of these platforms, you might not see our names, but we're the pipes in the back that's actually making this flow to your hands, basically. This chart, I guess, summarizes in some of the points that I talked about, because if you look at, for example, Royal Mail, again, the example I used, on that transaction 12 years ago, retail investors, i.e. all of us here in this room, generated 4 billion of demand for that particular transaction. That is quite a statement, because the retail institutional book, the retail demand was more or less 7 times oversubscribed versus the shares available. The institutional book wasn't 7 times, it was maybe 2 or 3 times. That tells you that retail showed up in huge numbers. So there is a lot of demand. As we look into some of the transactions that we ourselves have done in the last few years, and as you have seen from the presentation from, I think, some of the other previous presentations, that IPO volumes or issuance here in the UK have been at cyclical lows in the last few years, but we are looking at an upturn coming in very soon. And even in the cyclical lows, some of the smaller IPOs that we have done, like Raspberry Pi, who does little computer chip manufacturing, that is a global phenomenon. And then you have Applied Nutrition, a Liverpool-based protein powder manufacturer. These two businesses are British-grown businesses that has evolved over the years. And when they came to IPO last year, the British public basically put their feet where their mouth is. They have invested nearly £100 million into these 2 British assets when we IPO'd them last year. What that tells us as a team is there's significant retail demand, and as we look into January next year, as Nick will allude to, as the regulatory changes, this number is going to double, triple, we don't know, but this is the lowest point. So what that means is, as we look into the pipeline as of the deals that are coming, and I'm sure all you guys have seen the press, there's a lot of names in the press. I think the FT did a very good article, surprisingly, in the last couple of days, talking about a lot of the IPOs that are coming through post-summer, and they are probably going to be setting the tone as we look into next year. I think I talked about a lot of it, but I think here are some logos. I think all of it is in the press. I'm sure there are more in the press that talks about, but there are some exciting businesses out there that you and I can relate to. Zopa Bank, I know, because I have a credit card with them. They got the banking license. They started offering bank accounts just 3-4 weeks ago. they are on the journey that it's been in the press that they're probably going to IPO at some point in the next 12 to 24 months. When that comes, it's something that you and I can relate quite well with. And if we can relate quite well with, it should be relatively easy for us to invest in. Nick, over to you to talk about some of the more interesting aspects of the regulatory landscape we are in today.
I'm not sure if you're being ironic there with the interesting aspects, but I'll try and make this as relatable as possible, because it does have a huge impact on all of us as retail investors. So we thought it was just worth taking the time to just talk about that. And if you're in the earlier sessions with Lord Lee, he mentioned that as well. But just a kind of quick show of hands in the room. I'm just interested to know how outside of the, if you like, the capital markets bubble, people are aware of these kind of reforms. But prospectus and listing reforms, kind of show of hands, people that have heard of it, even if you're not familiar with it. Okay, excellent. James at the back, our co-CEO, put his hand up. That's good. Makes me happy. But yeah, about 50%, which is interesting, right? Because I think actually, in terms of the impact on the market and us as all of us as retail investors, it could be quite sizable. So just to kind of give you a quick overview of kind of what has happened and how, what has that journey been like. So it's been quite a long journey, really. It's kind of half a decade now, really, almost in the making. And it started off with this this Hill review rather in early 2021. That was important because it was one of the many reviews that the government kind of had in the pipeline at the time post Brexit, and trying to make the UK kind of more competitive and a bit of a differentiation from other economies and markets. And I think because we'd been a kind of a follower of regulation in the EU for a kind of a certain amount of time, the government at the time saw that as an opportunity to kind of, how can we differentiate ourselves? And so the Lord Hill Review made a number of recommendations in terms of making our capital markets more effective and efficient. And skipping forward, I won't go through all of these, but there's been a number of, that was the kind of like, if you like, the aggregator of all these different parts of regulatory change or further reviews, further legislative change as well. And fast forward to kind of 2024, 2025 this year, you're now seeing some quite significant changes which will impact us in the room as investors. So one was the listings reform, which went live last summer, and a couple of weeks ago, the prospectus regulation changes were announced by the FCA, which come into effect in January 2026. And just a couple of key highlights from that, and you'll be able, there's a lot of press around this. So again, I don't want to kind of go into a lot of detail with you now, but one of the things, for instance, will be the removal of this idea of a euro 8 million cap, which restricted a lot of issuances in terms of the retail slice of that issuance to 8 million euro. And what that would mean, and Fahim started to touch on it in his presentation, is you'd get this kind of restriction of allocation. So, for instance, the Raspberry Pi issuance last year, there was an 8 million euro cap on that, which meant actually if you applied for a certain amount, you may be scaled back in terms of your allocation. And so by the kind of process of removing kind of things like that means that when you apply, you've got a kind of a fairer chance of getting a kind of higher allocation, if you like, versus the institutions. So that's really important. The other thing is, in terms of the rules, is making it easier for companies to raise money. So there are various restrictions, and I'll just pick on one around the need for a prospectus if you were to raise 20% or above of your existing share capital. Now, the prospectus regulations have reformed that so that number is now 75%. Which is pretty high. There are a number of other kind of safeguards in place to make sure that, and checks and balances, if you like, to make sure that it's done within with the so as individual investors we can have a confidence in that raise, but it just means there's a restriction removed for the company, which means they're able to more readily go out and invest without kind of publishing a prospectus, for instance. So that's really important, and it's all these little kind of things, little points of friction, which previously made the ecosystem a more kind of difficult place for all of us, whether we be investors or advisors or issuers, which are just being removed and making it a kind of more frictionless journey for us. So again, I won't dwell too much on this because I spoke about the 8 million cap, which it mentions in the middle. But what's really interesting is these kind of graphs on the either side, the bar charts on either side. So just to highlight the one on the left for you, is just the kind of the amount of UK shares held by individuals, which, you know, we've spoken about in several of our and the general kind of public have spoken about, or commentators rather, in terms of getting that percentage up. So 11% being fairly low compared to someone like Sweden, who has got 20+%. But actually, even worse is this idea that, well, we've got 11% of UK shares held by individuals, but only slightly less than 1% of retail are able to participate in primary market transactions. So that's a huge kind of reduction, which we should be seeing 11% ideally. And on the right there is kind of the other side of the same coin, really. So, you know, how many transactions were there, including retail? Approximately 60. I think this is the 2024 figures. Whereas actually there could have been 440 if every single fundraise during that year had include retail investors as part of it. So we are kind of big, and myself and Fahim and Tush get involved in the kind of advocacy part as well as kind of doing the day job, just to kind of champion the retail investors' cause, really. And we think that's really important in terms of getting individuals involved in the markets. And this, for example, our Get Invested report, which we kind of published at the start of July, is a great example of this. We've kind of are very passionate about education, and you know, that comes personally for me. That's from growing up in a home where we didn't really talk about investing or investments, and I've kind of had to kind of find my way, you know, in kind of late teens, early 20s, and growing up in the industry, really. And again, in the previous session, we talked about, well, how about education in schools? And that was a real kind of highlight of this report, making sure that people are well educated. Again, Lord Lee talks about this idea of kind of television, and there's a lot of a fascination with property. And I just did a quick search after he mentioned that, and I've kind of found 8 mainstream TV programs which kind of look at property, and of course there's pretty much zero on the investment side. And wouldn't it be great to see Dion Dublin present a program on investment rather than Homes Under the Hammer, for instance? But this report that kind of we looked at investment. We also we shone a light on the kind of idea of what would it look like, Sid the saver versus Sid the investor. I'd love to get away from the kind of keep referring back to Tell Sid. So, you know, really looking forward to the kind of the push over the next 6 to 12 months, so we can stop referring back to the British gas campaign in the 1986. But that was really interesting because we obviously, so it's just a simple case of investing and compounding, but we used kind of UK FTSE All Share for our comparison, and you can probably see on the numbers there, you had like 600,000 if Sid was just to save in a kind of account which was fairly generous on our assumptions in terms of interest, versus investing in the FTSE All Share a certain amount each year. So again, that's a key part of what we do on the RetailBook side in terms of advocacy. And at that point, I'm going to hand over to Tush, who's going to tell you a little bit about our kind of distribution channels, but Also, if you're interested, a little bit about the QR code, which has been up on the slides.
Thanks, Nick. So just another quick show of hands in the room would be great. In terms of context of whether it's ease of participation, the information which is provided, or just general awareness, how many people in this room find their investing journey, your own investing journey, difficult? Right, it's quite a lot of people, probably more than 50% that you saw. Right, so that's a nice segue into the next slide. So you're not alone. We've been talking to all of our partners in terms of our distribution network. You can see it on the screen. As I mentioned in my introduction, we work with the largest investment platforms in the UK, all the way down to your local stockbrokers who are very traditionally high touch, smaller population of clients who need that personal concierge service. And what it's allowed us to do is understand what are the challenges that our partners see, because they've got that direct touch point with their underlying clients. And by doing that and by listening to them, it's kind of unanimous that a key thing is it's about notification and awareness. It's really surprising that some of the largest platforms, because they're so large, because they've got so many things to do, they often find that making their customers aware of transactions can be quite challenging. A lot of them utilize corporate actions tools. Now, the corporate action teams, for those that don't know, would only go to existing shareholders. But that doesn't mean that someone like me, who may be interested in the journey of a company that hasn't invested before, I would like to get involved. How do I know about that? So we took that back internally. We said, what can we do to make the lives of our partners better and in turn improve the investing opportunities for their underlying clients? So having thought about that, we thought, actually, there's another thing to consider. A lull market, not in terms of equities or in terms of transactions, also means that there's sort of a forgotten piece. So it's also a responsibility of ours as we advocate, the market's coming back up, waking up, stirring, whatever you want to call it. How do we make people understand that there are things happening? So that's when we started looking at our own internal capabilities. And we've actually created something called the RetailBook notification system. And what this service does, it effectively allows any individual investor to go onto our website, register their details, i.e. their their name, their contact email address, and who their current broker is. And we've been working hand in hand with all of our distribution partners to understand what they would like us to put as bespoke instructions on this notification service. So for example, if I have AJ Bell as my broker, when there is a transaction or when there's any kind of information in the market that we send an email out to or communicate out to those people that have signed up, if you have an AJ Bell account, it will say exactly what to do. It will say, please contact this team on this email address or this telephone number. What that has done has increased awareness, activity, and just general overall participation in all the transactions that we are currently delivering. And not only that, it's not just about when the transactions happen. We really want to build up this retail investor relation journey. We want to ensure that retail investors are getting, used to certain concepts, product classes. Fahim mentioned about the treasury bills. The treasury bills was a conception, 18 months ago. We've done a lot of work to educate investors, make them understand what is fixed income as a product class. And we are regularly publicizing, or producing in educational content, which we attach to these deal notifications. So it's not just about notifying a client at the point of a deal launch. It's really important to ensure that there is an educational journey for individual investors in the UK. And what's the result of that? So with education, with regularity, with information that assists an individual investor to understand what a product class is, we've seen an extremely strong result. So the success, as shown on the screen, tells you what happened at the start of this journey of launching treasury bills through RetailBook and where we are now. We've got over £1 billion worth of annualized demand, and this is only from a subset of partners that we are testing this product with. The reason why we're doing this is as markets wake up, as regulations change, individual investors are now used to understanding what a fixed income product is. So when corporate bonds do become available, you are all primed and ready to know what that means for you as an investor and what the opportunity is. And just as everyone has, I'm assuming, got a mobile phone, and we talked about the RetailBook notification service, please feel free to scan the QR code, and then you can see what I was talking about. Questions?
Thank you for your presentation. What is the difference in mentality between a company that engages the services of a traditional investment bank to target institutional investors compared to a company that has preference for retail investors through you?
I'll take that question. So I think just to give a bit more of my background, I'm like, prior to joining Primary Bid, I spent 10 years at Citigroup doing exactly what you just suggested, selling these IPOs to institutional investors. So when a company today is looking to raise funds, they obviously want to maximize how much they can raise or where it's coming from. They want a diverse shareholder base, which includes big investors, small investors, and the entire lot in the middle. What that happens is, so if, for example, I'm just going to come up with fictitious examples. So if a company is looking to raise, I don't know, 100 million, because they have this amazing acquisition or this amazing growth opportunity that they want to capitalize on. Traditionally, if you look at as I think Nick alluded to, about 11% of the UK market today represents UK retail investors. So by default maths, 11 million should be retail and the 89 should be institutional. That is what we want to achieve eventually. But I think we're at that journey where we are actually going and talking to these issuers, talking to the bankers, saying, yes, you can raise that 100 million quite easily because the opportunity you have is great. You don't need retail to get it done. But is it the right thing to do? That's the first thing. Do you have retail shareholders or customers or employees who wants to participate? Because at the end of the day, you as a human are a retail, you as an institutional is not. So that's the first argument that needs to be won over. Once that's won over, I think the next argument is, as Nick alluded to, there are a lot of regulation that prevents retail from getting in. A lot of it is now changing. For example, I'll give you an example. 5 years ago, when Moonpig did its IPO, everybody knows Moonpig. Some of it loves Moonpig, some of it don't. But everyone knows Moonpig. When we were trying to convince the bankers and the issuers around how to include retail at the height of the pandemic on that IPO, the Moonpig basically the management team and the bankers rightly said so. If we do a retail offer, we're going to be exposed to the market for a 7-day period. In that period, if the COVID results out of the US spikes or out of the UK spikes, our IPO is dead. We cannot do that. Why was it 7-day? As Nick alluded to, the regulations at that point in time prevented a retail offer to be shorter than 7 days. That IPO was done in 3 days. With institutional investors, they got their money and they left. Job done. So the discussion today is very different. If Moonpig were to IPO in January next year, we can go back to the same bankers and the same management team and going to say, it's not 6 days anymore, it's 3 days. Institutional IPOs cannot be done in less than 3 days, technically speaking, right? If you just think about, you've got to make a call, get the demands in. So that works. So what I'm trying to say to you is, not only the changing of mentality, but the regulation, all of those changing, what that means is as we look into the next 12 months or the next 2 years, the conversation is a lot more easier because regulation for a change is supportive. After the dot-com bust, the whole global industry, the finance industry, regulated retail out. Over the last 5 years or the last half decade, everyone is trying to bring retail back in. So we are in that phase where I think retail is now seen more favorably than it was even 5 years ago. So as we have those conversations, it's going to be easier. The reason I'm giving you this detailed explanation is just to give you the understanding. Because before it was 8 million euros, as Nick alluded to, on this 100 million example that I gave you, only 8 could go to retail legally. Now that's gone. That entire 100 can go to retail if the issuer wants it. Might not be the right thing for the company or the overall transaction to do, but it's possible. It wasn't yesterday. So as we move in these conversations, it's going to be a lot more easier and it's going to be a lot more frequent. So we do expect that, as Nick alluded to, 60 transactions included retail offer, 440 was the upside scenario. We expect that as we go into next year, that is going to be the likely scenario or as close to as possible.
Brokers seem to be increasingly reluctant to offer dealing accounts to investment clubs. At least part of that appears to be due to compliance burden, and it poses an existential threat to investment clubs. What do you think can be done to push back against that at a time when the government seems to want to encourage investment by the public?
I'll take that one to start with. So yeah, you're absolutely right, and I think in one of the earlier panels they alluded to the kind of the AML burden, and I think that's where it's driven from. Is certainly the kind of it doesn't fit in the nice box of individual investor, right? I get the passport for that person, and I kind of put it through the system and churn it through. What I would say, and we obviously we don't deal directly with end investors, so again, it's kind of my personal view and experience in dealing with this kind of regulation in my other roles and so on, is that a lot of the AML regulation is kind of broadly principle based. So there's nothing to say in terms of for an individual broker, right, there's a rule here which means we can't onboard investment clubs. It will be down to the kind of the risk appetite and associated with the kind of systems and controls that individual broker does have, and the resource they have to address those systems and controls. So are they willing to kind of invest in their compliance headcount or systems in order to make that happen? I think so. I think that's the interesting dynamic. I think helpfully from a kind of public policy government level, you're getting an increasing kind of positive pressure from a kind of, there's a friendly group of MPs, I'd say, in terms of that want to make that journey as frictionless as possible. And so they are looking and challenging things like not only financial services regulation, but some of the AML regulation in terms of understanding if that potentially has gone too far. And there has been some articles in recent months which more in the kind of financial press than mainstream media, but around AML and do we have too high a kind of bar in certain scenarios? It's obviously a really important subject still, and you still see the FCA are issuing fines for what I'd call a kind of fairly bog standard failures of AML processes and controls. But to your point, that's not necessarily investment clubs, that's individuals opening bank accounts and making sure they've got the right procedures in place there, which obviously is incredibly important. So I don't have a kind of a silver bullet for that, but rather just to say that, again, I feel there's light at the end of the tunnel in terms of the pressure and of the government and of certain MPs on the government, and some of the murmurings we're starting to see in the financial press in terms of actually should we be a bit smarter in terms of how we're looking at some of these processes for onboarding for things like investment clubs, for instance.
Like the other thing I would add is if you think about the impact of tech in this whole AML KYC world, I think we're seeing the starting of that phase. Because I'm sure you have, for example, accounts with multiple brokers. In some brokers, you can open an account in under 60 seconds. In some brokers, it will take two weeks. So it can vary completely. So as those things are upgraded, I think you'll see a lot more better access, because all of this process will also need to be upgraded at the same time.
I've got a question. Before that, I will say I'm a member of an investment club and have been for many, many years. And I can tell you that in our experience, no sensible broker would take on an investment club because of what is imposed on them, which we have every sympathy, and also on us, enormous amount of form filling every time a member changes and so on. My question is, I'm surprised and very interested in your emphasis on education, which I think is greatly to your credit, but also greatly in the country's interests. I don't know what other people think, but my experience of my friends who are otherwise intelligent is their money management on the whole is stupid. I mean, really incompetent. You meet friends who are surgeons and they haven't got time and they haven't got a clue. what would, and you are making efforts to change that in your way. What would be your recommendation for the key thing that government might do to change that situation?
I mean, I actually relate to what you're saying. Most of my best friends are dentists, and I have the same conversation with them. And they just, it's boggling. It literally shocks me when I go to them. Have you heard of Revolut? They're like, what's that for? They actually don't know because it's not in their wheelhouse to know, right? So I think that education, yes, it really does need to start at a much earlier stage. My father, he was a chartered accountant, and all the investment information I know was not from him, which is the most, again, surprising thing. It's just maybe something that's not spoken about at home. I think Nick alluded to that with his upbringing. And I think if we can start the conversation earlier, especially in schools, I think the government would be taking a massive step in the right direction. We're trying to do the same. So again, we have understood that actually when a transaction happens, whether it's a follow-on or a placing or even an IPO, a lot of the documentation that is produced by the company is very much for the institutional audience. So a prospectus document could be hundreds of pages. We have actually delivered documentation appropriately FinProm'd, or approved by financial promotions teams, etc., which is a lot more concise, a lot more easily, I think, digestible from an individual or an everyday retail investor. And it's proven to be really, really powerful. Even in terms of the deal alerts, which we have spoken about, we always try and provide some more context in terms of what are the proceeds of funds? Why is this company raising capital? And I think that really does impact the attention that's given by an individual.
And I'd just add to that, I think what's really needed is something kind of real mainstream media, a national campaign, and whether that's, and I think that, when we've certainly had discussions with with others in the industry, other industry stakeholders and government, there's the natural, and I think this is in any industry, not just financial services, but initially there's the finger pointing at government to say, come on, get us a national campaign together and let's you need to do that, government. But I think actually it's on all of us, and in that I mean us as RetailBook, the London Stock Exchange, the other industry players, to do that kind of education piece, and work hand in glove with government to do that, obviously. But I really believe, and I that something like a national campaign, which again they've started to kind of talk about or allude to in certain speeches recently, I think would be really helpful, and just get the message beyond capital markets, beyond this kind of the group here today who are will be fairly well informed investors, and we recognise that, but just to the surgeons, the dentists on the street, to make sure that at least they have that kind of fairly even if it's a fairly basic level of understanding, because that first step on the journey, even to a ETF or a fund, will hopefully be the gateway to then kind of single stock investments.
Definitely.
Last question, I'm afraid. Keep it very brief. Over to you.
The title of this panel is Putting the Public Back into Public Markets. We've got a population of 68 million. Are you even scratching the surface? And if not, what is your role plan for actually making an impact and making things happen?
I mean, I can talk about it from the partner's perspective. So our distribution network, as Fahim said, is 50 and growing. They represent a large chunk of the individual investor marketplace. And we are working with them to amplify education, content, deal awareness. And I think that's going to be step one. Culturally, I think there is a lot of conversation around this. I think that has to change. It's not surprising. We always talk about why is crypto so well known versus capital markets. So that's something which we need to address from, again, a grassroots level. But from my perspective, within the sphere which I manage, we're using our partnerships and trying to enhance those relationships that we have with them from an educational perspective, I think Nick has covered that pretty well, right?
I think the other aspect I will say is, like, if you think about the UK stock market and the brokers, there's a lot of them. If it was, just 3 or 10, we wouldn't be discussing this at all. Yeah. And also, if you think about this breadth of those, you got at one end of the spectrum, you got Hargreaves Lansdown with millions of clients, and then you got small brokers elsewhere. And you also got to think about the tech that each of them have. We might have a shiny tech on our side or a manual tech on our side, both ready to connect. So our shiny tech can connect to the most highly developed, neo brokers. Our old tech can connect to some of the traditional players. The problem is a lot of them don't even have any tech or any sort of integration. So how do they even integrate into those deals? So we're actually working with them in order to make sure that they're able to do that. Even the big 3 platforms or the big 5 platforms, their tech aren't the best. So we've been working with them in-house, trying to see, okay, can we do this? Can we do that? How can we actually plug in? So there's a lot of work to be done. For example, just the plumbing and the connections, because Hargreaves with 2 million plus clients might want to do few things, might not everything. A smaller broker in Chelsea might want to have a different view on life, on how to do, because they're driven by their clients. So there's a lot of that as well outside of education, and it will take a long time. And if you think about some of the global markets, like for example the US, they have invested heavily in tech 10 years ago. So if when you look at Robinhood in the US and you try to compare with Hargreaves Lansdown tech today, it's night and day. I'm not saying Hargreaves Lansdown's bad, but it's getting there. I think once we have that overall upgrade in our tech and infrastructure, it's going to be much more easier to encompass the 60 million at that point in time as opposed to today.
And I think just quickly before we close, I've got to just mention, so James, who's sitting at the back, he's our co-CEO, me and him often have these conversations, right? His experience is completely different to mine. And we're often actually discussing this. So whilst we're doing what you said, going out to, I would say, more seasoned investors, I'm often that voice in the room with James, and he actually listens to me and he says, I said, James, what about those 18 to 21-year-olds? Have we done anything at, let's say, LSE as a university? We know that they have a constant production line of fantastic future leaders in the finance world. Are we doing anything with them? And that's where that conversation starts, and that's when we've got plans in the pipeline to do something at that level. I think there's going to be an inflection point where the younger generation are going to be the driving force in this, right? And they're going to be investing in a very different way. Their source of influence are not going to be maybe a broadsheet. They may be social media, it may be influencers, right? So these kind of things have to be taken into consideration as we proceed.
Right, well, we'll have to call it quits there. So thank you, gentlemen, very much interesting presentation.
Thank you.
Thank you.